We hit the ground running this quarter. The S&P 500 closed in on 7,000, while the Dow bore down on 50,000. The market's expectations were for the economy to bounce back after the government shutdown in the fourth quarter of 2025. Hello, everyone. This is Nicholas Shaheen, Vice President and Financial Advisor at Financial Services of America. I hope everyone is in good health and has had a great start to the year. It's hard to imagine that we are at the end of the first quarter of 2026. What a decade these past 3 months have been. It feels like it should be 2029. With everything that has happened in the past 3 months, these next few minutes will feel like Chris Berman's football highlights on Monday Night Football, only a lot more serious. We hit the ground running this quarter. The S&P 500 closed in on 7,000, while the Dow bore down on 50,000. The market's expectations were for the economy to bounce back after the government shutdown in the fourth quarter of 2025. Then President Trump ordered U.S. troops to capture Venezuelan President Nicolas Maduro, who was accused of harboring narco-terrorists and being involved in trafficking narcotics to the U.S. Venezuela had been sanctioned and a warrant had been issued for his capture, but so far nothing had been done except for the sinking of drug boats in open ocean. All that changed with Maduro's capture and the vice president of Venezuela took over. Things quieted down after a brief scare for the markets amid oil prices and the potential of further U.S. involvement. Markets resumed their climb, and the S&P 500 almost closing above 7,000 and actually topping that level briefly intraday. The Dow broke through the 50,000 level as new records were being set regularly. Yet there were worrying signs on the horizon, notably that jobs were weakening while inflation was still elevated and stagnant. The Federal Reserve met and decided to suspend rate cuts, citing elevated inflation amid a stable jobs market. The market did not like that message, and Fed Chair Jerome Powell drew the ire of President Trump, who has been agitating for lower rates. The administration went so far as to open a criminal investigation into Powell's management spending on the Fed's new facilities, which prompted an unprecedented video response from Powell in his own defense. All the drama had markets in a tizzy as we ended January. Trump ramped things up even further when he named Kevin Warsh to succeed Powell in May as Fed chair. Markets took all that in stride, deciding that with Powell basically a lame duck until April, we would not be seeing rate cuts until the second half of the year. Markets began what was termed the Great Rotation. Perceived overvalued AI and big tech stocks were sold, while undervalued large cap stocks, along with mid and small cap stocks, were scooped up, leading to a prolonged period of volatility. Mercifully, we avoided a second government shutdown, but the full government was not funded. The sticking point was overfunding the Department of Homeland Security, specifically funding for the Customs and Border Patrol and Immigration and Customs Enforcement, CBP and ICE, respectively. Both agencies were engaged in high-profile enforcement operations as 2 protesters were killed during the confrontations, and Minnesota was concurrently embroiled in a scandal regarding fraud of funds. Needless to say, funding has yet to be resolved, even though it resulted in the ouster of DHS Secretary Kristi Noem. Plus, CBP and ICE have largely scaled down their enforcement operations in Minneapolis. Back to the markets. The January jobs report was strong, but it turned out to be a flash in the pan. The jobs picture has continued to weaken while inflation remains stubborn. Meanwhile, fourth quarter GDP initially came in at a very weak plus 1.4% and was revised further down to 0.7%. We are staring at a stagflationary situation, with low growth in GDP and jobs while inflation remains stagnant and is expected to tick up. The next shoe to drop was the February Supreme Court ruling on the Trump tariffs. The court ruled the president did not have the authority under the International Emergency Economic Powers Act to enact tariffs, although the administration cobbled together basically the same tariffs as before. That opened up a whole new can of worms, and we had a mini tariff tantrum in the markets. The matter was not and still isn't settled, and we do not know what will happen a few months from now. As if all that wasn't enough, on February 28th, the US and Israel launched Operation Epic Fury. The top leadership of Iran was wiped out, and a devastating bombing offensive has continued throughout March. How this all turns out is still up for debate, but the near-term impact was highly predictable. Oil spiked from the $60 range to over $100 per barrel, and markets plummeted as volatility shot up. The price of gas nationally rose 50 cents a gallon overnight and could go higher the longer the conflict lasts. Given Iran's proximity to oil production and shipping in the region, the disruption is having a significant impact on world energy prices. The market gave up all its gains for 2026, and now there is talk of higher inflation and, dare I say, recession. Again, that's all talk, and if the situation is resolved soon, the worst can be avoided. But I would not go to sleep on current events right now. Some bit of optimism is that I do not think this conflict will escalate into anything global. Iran is pretty much alone right now, and not even its so-called friends, the Russians and Chinese, are coming to their aid, at least outwardly. Nor are Hezbollah or the Houthis. For now, the world is supporting the US and Israel's actions. They do not want a nuclear-armed Iran. That lesson was learned with North Korea. As I said, what a decade the last 3 months have been. We are still in the middle of some trying times. I am hopeful that the situation in Iran will be resolved soon and the market will return to normal, although normal has been redefined in a lot of ways. If the conflict is resolved in the next few weeks, I expect a big rebound as markets will focus on valuations, earnings, and rate cuts. Hopefully Q2 will not be as tempestuous as this last quarter has been. Still, it would not hurt to check in with your advisor to make sure your plan is intact and your goals are still on track. I will see you in a few months, hopefully with better news and to recap a strong second quarter of 2026. Again, call your advisor with questions. Stay the course and be disciplined. Remember to control what you can control and let go of that which you cannot, and do not let the moment overwhelm you. Take a moment to breathe and try to enjoy every day. Try not to stress. You can control that. Thank you. Be safe and take care.